Good afternoon, everyone. And first of all, thanks a lot for joining, taking out time from your occupied schedule. It's a pleasure to host all our customers. This is Abhishek Mehrotra, Head of Investment Products with HDFC Securities. And we are very lucky to have Mr. Kalpen Parekh, who is the CEO with DSP. I'll give a quick brief to Mr. Kalpen before I just thanks my audience for coming up a little late. So there was some technical issue which we were trying to sort out, but hopefully it is done now. So all those people who have joined, just to tell you, Mr. Kalpen is the CEO with DSP. He has more than 2 decades of experience managing investments, and today we have requested him to come and address a very special topic about diversify to Fortify. The reason to call for this discussion was to understand what is there in the market currently. We all are aware how market has behaved of late and how things are moving across various parameters, which could be interest rates, could be geopolitical issues, which could be credit cycle. So without taking much of time, Mr. Kalpen, can you take us through what is multi-asset approach right now, and what is this product about, which on the DSP's shelf now? Over to you, sir.
Sure. Thank you. Thanks, Abhishek, for inviting DSP and me for talking to your esteemed investors. See, very simply put, each of us as investors, we invest in different asset classes, either by mixing them or separately investing in them. Investors are known to have invested in stocks, in equity funds, in bonds, or in debt funds separately, in gold, or a lot of high net worth individuals in the last 2-3 years have started investing in global stocks or global funds or global stocks via LRS. People do investments in real estate as an asset class. So this whole concept of investing in different asset classes is not anything new. What we are trying to only do right now is to blend these together, because mixing them at the right time with the right weights can help in achieving a couple of outcomes. It can help in increasing the return of the portfolio, keeping the risk the same, or it can help in it can help in significant reduction of the risk. So there are multiple objectives that combining asset classes can bring. And I want to start with an example. And Abhishek, if you don't mind, if you can move to the next slide, which shows that, yeah. So I just want to start with an example of science, and we relate a lot to science because science is time tested over centuries and centuries. And here I've just shown on the left hand side an aluminum foil, which is made of 99% pure aluminum, and this is the foil that we use every day to pack our lunch bags or food. And after we are done with food, we are able to crush this foil and actually put it in the dustbin. So it achieves the objective of keeping the food warm and fresh, but it can be crushed, so it doesn't have hardness or strength. Now, in the same aluminum, where 99% was aluminum, if you introduce small proportions, and I'm just saying small proportions, not very large proportions, of zinc, of magnesium, and copper, the new aluminum that is formed after that, the strength and the hardness increases so much so that that aluminum is used also for construction of aircrafts. So basically, thoughtful introduction or mixing of the right elements in the right ratio can actually strengthen the product. In our case, it can strengthen our portfolio, and which is why this whole concept is called diversify to fortify, or diversify to strengthen our portfolios. If we move to the next slide, I'll just highlight that that what is the proof that this helps in strengthening the portfolio. Real strength of a portfolio is actually seen when most things don't work, or when there are sharp corrections in the market. And why more so during sharp corrections? Because all of you would know that if 100 rupees becomes 50 rupees, on paper it is a loss of 50%. But to go back to 100, markets don't need to rise by 50, they have to rise by 100%. That asset class has to rise by 100%. So minimizing drawdowns, we use the word drawdown, it's basically minimizing sharp corrections or losing large amount of permanent capital, losing capital permanently in very big meltdowns actually derails our long-term compounding of our hard-earned money. So when we look at a combination of multiple asset classes, and here we have combined 4 asset classes: stocks from India, great companies from rest of the world, bonds from India, and precious metals like gold and silver. If we combine a portfolio like this in a ratio of 50 rupees in equity, 25 rupees in bonds and gold, or it would be 60-40. That ratio can be fine-tuned depending on market cycle, but broadly around 60 rupees in growth assets and 40 rupees in protection assets. That combination sees significantly lower corrections or lower loss of value in sharp periods of crisis. So whenever every 7 or 8 years we have either an economic crisis, or we have a macro crisis, or we have an event like COVID where you see 30, 40, 50% drawdowns in markets or in our core asset class called equity. And in such periods, a combined asset class actually falls less. And if we move to the next slide, Abhishek. This is the proof that if you take the history of last 23 years, since the time, price data for all these 4 asset classes is collectively available, an investment in Nifty, which is Indian equities, over the last 23 years has earned 12.8% return, which is the CAGR. If you see the table, the second column in the table, but the third column is important. That 12.8 comes with fluctuation equivalent to 22%, which means annually you can see plus 22 or minus 22 in terms of range of volatility. That volatility can be negative on the lower side when markets fall. It can be positive when from low cycles markets actually rise. Now, if you look at gold, another asset class which is a very precious asset class for Indians particularly, who have been saving in gold for generations and generations, and gold is a 5,000-year-old asset class. All other asset classes have history of 200, 300 or 400 years. So gold over the last 25 years has earned 11.4. So it's not too less, significantly lesser than equities. It is more or less, very close to equity, but slightly lesser standard deviation. It has 17% unit of fluctuation. Then we look at the third asset class, which is, global equities. Global equities, the number looks a bit low. We have taken very conservative numbers. Here we've assumed that we had bought the entire MSCI all country world index, which is all the top 5,000 countries of the world in small proportion. That would have earned 7.9% return, with slightly lesser fluctuation of 15%. Now, incidentally, in the last 10 years, this 7.9 has actually been 12 to 13%. It is actually higher than Indian equities, but this is data for 23 years, and it includes the first 8 years when Indian equities gave superior returns, whereas global equities had almost zero returns. So don't get influenced by the number 7.9. It looks a bit low because it started at a wrong point in the year 2000. And then we look at debt. Debt has delivered 7.5, but with the best safety. The standard deviation of fixed income is only 1%. Now, if we were to mix these 4 asset classes in a combination of 60-40, 60 towards equities and 40 towards gold and bonds, the collective return comes to 12.2, but the standard deviation drops significantly to 12%, which is almost halving of volatility. And now when you see the chart, if you see, the chart here, the green line is Nifty, which has highest return at 12.8. But the fluctuation of green lines, there are periods when the green line for 3, 4, 5 years has not even crossed the stable blue line. The stable blue line is of fixed deposits or fixed income or debt or any steady state growing instrument. So if you had invested in 2000, the first 3 years were years when Indian economy had collapsed. World economy was slowing down after that Twin Tower attack. Those 4 years were very bad for equity as an asset class. But in those 4 years, bonds did very well, gold did very well, which is why the multi-asset strategy would have actually outperformed even equities at that point in time. Then between 2003 to 7, Indian equities did very well, but gold did not do as well, or bonds did not do as well, or global equities did not do as well. But from the 2008 peak, if you can see that pyramid top in 2008, the green line, it crashed by 50%, and almost for 5 years it gave zero returns. It took almost 5 years for the same price to recover. But in that period, actually gold took off. Gold went up by four times, 400%, in the period when equity did not go up. So this concept of multi-asset portfolios is basically, you know, creating a group of players where when one player is resting or is retired, hurt, or has come back to the pavilion, the other player will continue to play the game and ensure that the game continues to progress. And likewise, in investing, your money continues to progress. The rate of progress may be slower sometimes. The rate of progress will definitely not be the highest like the best performing asset class, but it will continue to progress on a very, you know, steady basis. And that is the whole beauty of multi-asset. We go to the next slide, where you know, I want to just highlight that why is the value of multi-asset so important? Because there are many times arguments that, you know, India is a growth country, India has a lot of growth, why should we think about investing outside India? Or if India has growth, why invest only in equity? Why not invest only in equities? Why should we do fixed income or gold, and so on and so forth? And here, you know, we've just taken 4 countries which were countries with very poor returns in their core asset classes, or countries where their economic profile has really deteriorated in the last 10 or 20 years. So we take Pakistan, for example, where, you know, the country is on the brink of collapse as we speak right now. Inflation is as high as 10%. And remember, ultimately, the objective of our wealth is to beat inflation. If we cannot grow our portfolio's return higher than what inflation is, we are losing purchasing power. We are becoming poorer and poorer every year because of inflation. So, you know, the objective of any portfolio, whichever fund you invest in, is not to beat another fund or its peer group. The objective is it should be able to deliver 3 to 4% higher than what long-term inflation is. And if we are able to achieve that with reasonable stability, we have achieved our objective. We keep telling our investors that don't panic or don't get greedy looking at temporary stock market highs or temporary stock market lows. Ultimately, our single-minded objective is, can we deliver 3 to 4% higher than long-term inflation, which is around 6 to 7% in India. If we can do more than that, we have achieved our objective. Now in Pakistan, and these are all returns of that country in its own local currency. In Pakistan, in the last decade, equity has earned 7% returns in Pakistani rupee. But that 7% is peanuts or is meaningless because its inflation was 10%. So their equity investor actually lost 3% every year. He was poorer by 10% on inflation account, and he was able to recoup only 7% out of that. So every year, your real rate were 3% negative, you know, 7 minus 10. But if an investor had done multi-asset, where he had invested in Pakistani equities, he had invested in global equities through, you know, all global funds. He had invested in gold, which is denominated in their own rupee, and he had invested in their own bond market. The average return would have come to 13%, because while they did not make money from equity, and they definitely lost money in their fixed income, because any country where inflation is so high, their bonds don't make money. They made significantly high returns from their currency because their currency actually collapsed. And when your currency collapses, gold is denominated in USD. So you get advantage of a dollar appreciation or a rupee depreciation. And that 50% of the portfolio, which was in defense, in gold and in bond, in global stocks, that actually made up for the poorer returns from their domestic currencies or domestic assets. So likewise, you look at Greece from 2002 to 12, and we have again taken the worst period to highlight, because it is typically in worst periods where these safer strategies really become valuable. Greece was on the brink of collapse. You know, it was a part of the pigs country which were defaulting. They were not able to pay back their you know, interest payments to you know, the IMF and to a lot of other investors around the world. Their inflation, like rest of Europe, was reasonably well behaved at 3%, but their stock market returns were only 14% negative. They were negative for 10 years, which means you invested 14% negative for 10. It means your 10 rupees had actually dropped down to 2 or 3 rupees. But a multi-asset portfolio still earned them 3% return. At least it came back to close to inflation, because again, what saved them was gold and international equity. The same story for Turkey. Turkey is at a point where their equity markets have delivered 15% in the last decade, because some of their companies have actually grown profits and their share prices have gone up. But that 15% again has no meaning if your inflation is 19%. A 19% inflation means you're earning 4% lesser than you know, what your stock market has given. So because it is an inflationary country, their currency has collapsed. So any investment again in global stocks and gold has made up a lot of money for them. And their multi-asset allocation fund has earned 28% return. Japan, a very interesting developed country, unlike the first three. one of the most developed countries. We all may aspire to, be a country like Japan in terms of technology, innovation, manufacturing, but their country has a very opposite problem. They do not have inflation. The inflation has been zero there for the last 20 years, last 30 years. Their stock market has earned only 1% return over 30 years. Imagine what does this mean? That, if a child is born in a family and you were to give him a gift of 1 rupee, after, almost 72 years, that 1 rupee will become 2 rupee. That low is, so only when that child, becomes an aged guy, that 1 rupee becomes 2 rupee. That is the type of problem where interest rates are very low and returns are very low. Now, their investors also made 5% from multi-asset because they ended up making money again through global stocks and global bonds and so on and so forth. And now in the table below, we are showing 4 countries which are not crisis countries, but which are stable countries. These are countries which are the top 4 economies of the world. They've become dominant over time. India is, one of the latest entrants in terms of high growth and large size country. So US market, 3% inflation for last 20 years. Their equity market returns are 8% in dollar terms, which is very good, which is not a bad return at all, because in rupee terms, that 8 will become actually 12 to 13. And their multi-asset asset allocation strategy has earned 7%, very close to their equity market. Likewise, in China 25-year returns are zero right now, because 30-year returns are actually zero because of the recent collapse in their stock prices. 20-year returns in equity in Chinese yuan is 6%. And asset allocation return is 6%. We'll go to the next slide quickly, because the key takeaway here is, in stable economies, asset allocation will give you slightly lesser returns than equity, but at significantly lower volatility. And in crisis economies, asset allocation is the best product because it is able to overcome the depreciation of your own currency. Now, 10 years from now, 20 years from now, my assumption is all of you who are listening to this call are people who are investing for really long term for the next 10, 20, 30 years. We all hope and aspire that India will be a dominant country in the niche wala bucket and not in the upar wala bucket. But the fact that your portfolio can have some amount of gold and global stocks is a hedge against something going wrong. Things can go wrong. Things don't always work. Anything can happen in the world. Overnight, Russia became a rogue country because of their, political misbehavior. Overnight, stocks in China are, going through sharp corrections because the government changed its economic policy towards capitalism and, started imposing new norms and new curbs. And while the Chinese markets are not doing well, they are making money through other part of the portfolio. Now, let's look at the India growth story. No doubt, over the long term, India has grown. So the first chart shows 13.3% return of nominal GDP of India. What is nominal GDP? It is our 7% GDP growth rate plus roughly around 5 to 6% inflation. So that brings us to a 13% overall economic growth. The stock market over these 30 years has also delivered similar returns. So, but it does not necessarily have to be so. In China, the data is very different. Last 25 years, China nominal GDP has grown at 10 to 12%, but the stock market return actually is only 5 or 6%. So there are patches in between where the stock market returns and the GDP growth do not really connect with each other. After the Harshad Mehta scam and the bubble which happened in stock market in 93, since then our GDP grew by 12%, but the Nifty was almost flat for next 10 years. 93 to 2002, 9 years, the returns were zero. Likewise, after the 2007-8 bubble, when world over all stock markets had risen very sharply, and then there was a 50% correction. Again, in the next 5-6 years, our GDP went up by 15.7. This 15.7 had 8% coming from GDP growth rate, and another 7% was on account of inflation. And actually, inflation is harmful to our wealth. So 15.7 looks good, but a large component of that was through inflation. In that 6-year period, again, stock markets gave zero return. So many people are surprised when we show to them that each asset class, it's not just equities, each asset class over long periods of time, if you buy them at the wrong time, can actually give you very poor returns. Sometimes zero, sometimes negative, sometimes less than even bonds, sometimes less than even fixed deposits. Gold for 10 years has given zero return. US for 10 years between 2001 to 2010 gave zero return. Japan for 30 years has given zero return. India in certain pockets for 10 years has given zero return. Now, when your dominant asset class does not earn return or earns poor return, if your portfolio has some other asset classes blended in the right combination, available in the most tax efficient way, that is where the need for multi-asset investing becomes relevant. Next slide, Abhishek. Now, this slide just highlights the context, and I mentioned that in the long term, Indian markets have the potential to earn between 10 to 12% net of tax returns in equity as an asset class, and maybe 10 to 11% returns in a multi-asset combination. But where we stand today, we are at a point in time where our valuations are rich. We measure valuations through price to earning ratio. In India, Nifty has a price to earning ratio band from 10 times to 24 times. When markets are in crisis, when headlines are negative, and when it is a great time to invest, our P ratios are 10 times. That time, all news flow looks negative and there is very little courage to invest. And when all news flow is positive, when headlines are positive, when all stories are positive, when we are, constantly talking of a better future for the country, for the economy, investors are very confident of putting new money. You are seeing huge inflows right now happening in, equity funds, small cap funds, stocks, markets overall. These are euphoric times. These are times when valuations are on the higher extreme. So today we are at around 22, 23 times. We are not at a bubble level, but we are reasonably expensive. Generally, when valuations are expensive, if you see the right chart, it shows that Nifty's future returns, next 5-year returns, on an average, have been around 9%. Now, these are average. It may mean 11% for some investors. It may mean 7% for some investors. But at large, most investors would have earned 9%. On the other hand, a multi-asset portfolio at large would have earned more. Now, whether it will be 11.8 or 10.8 or 9.8, I don't know in the future. But generally, it has been observed that multi-asset returns are slightly higher than equity returns when you are investing at all-time highs, like where we are today, or at peak valuations, also again like where we are today. So the takeaway here is that when markets are, euphoric, I would rather invest in something which is defensive. When markets are defensive and pessimistic, I would rather invest in something which is aggressive. We have to be counter-cyclical in our approach. We'll go to the next slide to, highlight how do we do this. Now, this is a concept where we intend to blend these 4 asset classes in different ratios at different points in time. But at large, the portfolio will always have minimum 35% in Indian equities and at least 10 to 20% in global equities, because we believe in the long run, it is only equity as an asset class which has earned superior returns over other asset classes, as well as is able to deliver returns better than inflation. Other asset classes temporarily give high returns, but do not necessarily permanently give high return, like fixed income. Fixed income returns always will be between 7 to 8% at prevailing interest rates in India. Whereas equity returns, the potential for equity markets in the world and in India is roughly between 9 to 12%, reasonably higher than fixed income. Gold is a joker in the pack. There are years it gives 0 returns and there are years it gives 20-25%. But it cuts the volatility of equity very significantly. So as we stand today, the fund will have around 40 rupees in Indian equities, 25 to 30 rupees in global equities, 15 to 20 rupees in gold, and 10 to 15 rupees in Indian bonds. This number can fluctuate by plus or minus 10% depending on which asset class is cheap or expensive. And that is something we will keep watching every quarter when we build the portfolio. Now, another important aspect is after this year's budget, investing in bonds or debt fund has become tax inefficient. You have to pay the highest tax slab. Whatever is your marginal tax slab, that entire rate gets charged. So let's say if you are going to earn 8% return in a debt fund, but if you are in a 30% tax bracket, your net return would be 8 minus 2.4. So it drops sharply to 5.6. If you are investing in gold, and let's say gold gives you 10% return over the next 10 years, and if you are in the 40% tax bucket, 10 minus 4, 6 rupees is your final return. There are brilliant investment opportunities in the rest of the world today, with so much happening in technology, in healthcare, in innovation, in semiconductors, and even the old traditional businesses like luxury brands, liquor companies, gaming companies, consumer companies, engineering companies. There are brilliant companies in the rest of the world which can earn superior returns to Indian stocks. But if you invest there, you end up again paying 30 to 40% tax. The beauty about this combination of multi-asset, when you mix it together in a combination that I highlighted in the previous slide, the tax, your taxable capital gains is computed after allowing for indexation benefit, after negating the impact of inflation. So if let's say the portfolio were to earn 10% return over a long period of time, and if inflation in India is 6%, your taxable capital gains will only be 10 minus 6, which is 4%. And on that 4%, you would pay 20% tax, which is 0.8. So on your overall 10, the effective tax is 0.8, which is equal to 8%. So mixing the portfolio through a fund structure like this enables you to take advantage of multiple asset classes to reduce your fluctuations and also reduce the effective tax outgo. And that is why we thought of mixing the product in a fashion like this. In fact, the next slide really highlights. So there are two ways in which one can design the tax structure. One is to keep it in the equity tax bucket, where long-term gains are taxed at 10%. So there the tax rate is 10% plus some nominal surcharge, so roughly around 11%. On the other hand, we have chosen the indexation route because in a country where generally inflation remains moderately high or at times even high, it is better to take the indexation advantage for taxation. So we have taken the second tax route, which is debt taxation with benefit of indexation if you stay invested for more than 3 years and above. And in that bucket, so normally if we look back at history, 73% of times the indexation-led tax design has delivered lower tax versus the equity tax design. And 27% of time the equity tax design works more favorable, but marginally. So I think the key message here is that while the difference between the tax charge in both the cases is very nominal, but more often 73% of times the debt taxation works more favorably. And in the last 1 or 2 slides, I'll just highlight what are the risks here. See, any investing is always risky. Every good opportunity has two sides of the coin. If let's say in the next 5 or 10 years Indian markets do very well, then this fund will underperform a pure equity fund. Or in the next 10 years, if gold gives very poor returns, then this fund can underperform a simple equity fund. But these are all extreme, 1%, 5% probability scenarios. Most often, generally the long term in the future is very similar to the long term in the past, because long term trends do not really change dramatically. The beauty about this fund is it aims to earn returns closer to equity, not exactly equity, at volatility is far cheaper or far lower than equity. So I think that is the whole backdrop. We are known as a fund house to offer products very selectively. We don't launch NFOs too frequently, but we try to time the markets. We try to time the asset classes. Today we are at a point in time where last 10-year returns of gold is only 5%. Last 10-year return of bonds is only 7%. But Indian equities have delivered around 18% return in the last 10 years. So equity is slightly an expensive asset class, whereas bonds and gold are relatively cheaper asset classes, and which is why we want to have 40% in these two cheaper asset classes and 60% only in equity. So I think that is the backdrop. Now, I'm done from my side. Open to questions. Abhishek, over to you.
Sure, that was very elaborative, but and really a lot of fresh data points our investors would have got in terms of understanding markets, especially on the global side, because most of our engagements with customers are on the Indian equity markets and more deeper inside stock level. So this was definitely insightful. Thanks a lot, Kalpen. So before I ask, so all the investors who have joined the call, they can write your questions on the question bar, while I'll take some of them which I already have and I noted down, and before I read out investors' question. So Kalpen, as you were sharing that gold has been generating returns, but in India, what we have seen is over the last 10 years, it's primarily the appreciation of the gold appreciations primarily come because of currency movement. So what's your view on that? And yeah. So how do you see gold as being positive about it, or?
Okay, so absolutely right, Abhishek. See, gold is nothing but a protection against your own country's currency depreciation. And if we take the last 30 years, barring very short buckets like 2003 to 2007, where we had huge amount of inflow and overall markets were well behaved, our currency was stable or rising. But barring those 4 years, on an average, we see currency depreciate by 3 to 4%. And once in 10 years, the volatility bunches up. What happens is volatility sometimes moves in a very orderly manner. Currency depreciates in a very orderly 2-3% year on year, and suddenly in 1 year, it will drop by 10%. The last 18 months again are a testimony of that. So whenever world markets turn volatile, global markets turn volatile, US dollar strengthens and all emerging market currencies weaken. So gold, because it is denominated in USD, number one, it gets that advantage. And typically, whenever there is volatility like this, is when equity markets also fall. So on one hand, if your entire portfolio is in equity, it will go through that drawdown on one hand, and on the other hand, in dollar terms, you're losing a lot more because your currency is becoming weaker. Secondly, this is a more fundamental and conceptual point. When you look at these three asset classes, equity, fixed income, which is bonds, and the gold, the only asset class which cannot be printed by just pressing a button is gold. Gold needs to be mined, and for the last 10 years, the supply of gold in the whole world has risen only by 1%. So gold is not in ample supply. Now, what is not in ample supply is generally called precious, which is why they are called precious metals, and which is why they've lasted for 5,000 years. They may not have given the highest return, but they preserve value of your, money. Now, 2 years back, the Federal Reserve, one of the deputy governors from the US Fed, was doing a testimony to their Senate or to the House, and someone had asked this question that every time the world catches sneeze or something goes wrong, COVID happens, war happens, all countries come with a stimulus, and they come and print currency. They come and borrow a lot of money, and they pump a lot of this liquidity in other asset classes, creating a bubble. How do you guys do it so quickly? How much time does it take to borrow another $1 trillion? And this person in the testimony said that it takes us as much time as pressing the button print on our computer, because most in today's world, they just need an approval to raise new money to issue more bonds. So bonds are in constant supply. Their supply base is rising, which is why the interest rates are rising, because anything which is in oversupply loses value. Stocks are in oversupply in bull markets, because if you read today, this year alone, 80,000 crores worth of stocks have been sold by promoters. Promoters are selling their stake. They are realizing मेरा भाव इतना बढ़ गया है मेरी कंपनी का, मुझे खुद को भरोसा नहीं हो रहा है मेरी कंपनी का प्राइस इतना अप्रिशिएट क्यों हो रहा है स्टॉक का, तो थोड़ा बेच दो. So that stock is coming to the market. Every year there are IPOs through which stock supply comes in. And on the other hand, gold is an asset class which is devoid of supply. So that is the place of gold. Typically once in 5-7 years, it makes up. So it goes through a lull phase for long, and then suddenly it takes off. So COVID jab hua tha, when markets fell 40-50%, gold was up 30-40%. Now remember, here is an important point I want to highlight. When markets fall down, I'm sure all the listeners who are listening to us, people like me, will be sending out messages to you, emails to you. If you have friends who are in mutual fund industry or wealth management industry, they will write you on WhatsApp group. सब अच्छे कोड लिखते हैं वॉरेन बफेट के. वो कोड क्या होता है? Buy more when there is blood on the street. बट वो buy more के लिए पैसा कहाँ से आएगा? अगर पूरा का पूरा पैसा इक्विटी में लग गया है या रिस्की एसेट क्लास में लग गया है और वो ही 40% नीचे है, तो नया कहाँ से खरीदोगे? तो वो पैसा मिलता है सेफर एसेट क्लास, या जो एसेट क्लास एंटी फ्रेजाइल है या जो ऊपर गया हो. नाउ remember, I'm not painting a glorified scenario that every time markets crash, gold would have risen or bonds would have risen. But generally, at large, 60-70% of times when markets go through a sharp correction, these two asset classes generally have gone up by 5, 10, 20%. And that is where you can, book those profits, or even, sell some of those asset classes and shift here. If you do it on your own in today's world, in today's tax regime, every time you transact, you will end up paying 30 or 40% marginal tax rate. If we do it on your behalf, inside our fund, virtually there is no tax at all. And only at the last day when you redeem money, there is an average 10% tax. So this is the value of gold. And in more so, if I have to take a forward-looking view, see in this entire presentation, if you look at it, there is no view. We don't believe in giving views because forecasting किसी को पता नहीं होता. It's like a coin toss. But gold में हो क्या रहा है कि as more and more countries print currency, lot of central banks are now increasing their holding of gold. Because they are realizing कल अगर यूएस ने अपना दुकान बंद कर दिया, जैसे रशिया को बोला you can't take your government bonds out, we are freezing it. So a lot of geopolitical tensions and scenarios could be very different in the next 10, 20, 30 years. And as a small hedge against that, we felt gold becomes a very important asset class.
Yeah, that was really very meaningful. So Kalpen, while you were taking through the assets, so over long term, though, equity has outperformed debt market, but short to medium term, we have something called balanced advantage funds,
Yes.
which participates into debt. So how does this differs with the balanced advantage categories where there's
Sure.
some portion of debt allocation?
Actually, till the time this concept of multi-asset got evolved in our country in the last couple of years, balance advantage funds, or I call them dynamic asset allocation funds, which dynamically move between equity and bonds, is a brilliant concept. So, this new fund, just because we are introducing this new fund, does not undermine the beauty or the benefit of the design of balance advantage funds. They are great funds. They are also meant for earning, returns nearer to equity at fluctuations far lower than equity. So, in terms of its intent, both are doing the same thing. Maybe in terms of outcome, both may give very similar outcome, but balance advantage funds were playing like a test match or a T20 match or a World Cup match as an Indian team, because it had only Indian stocks and Indian bonds as their key players. With introduction of gold in a way is an international asset class because its returns are driven by USD and global currency. And with introduction of global stocks so we are adding these two asset classes to the balance advantage fund construct. So in a way, you're creating an IPL team with some global players also. So if today, in my team at slot number 4, 6, and 9, I need an international all-rounder, an international fast bowler, and maybe an international slog over hitter from South Africa or Australia or US or West Indies. The multi-asset allocation fund is actually, creating higher odds of achieving similar objective like a dynamic asset allocation fund, because it's adding two more players, and these two players behave very differently at times compared to the two Indian players. So its intent is the same. Its
Right.
outcome may be the same, but it basically just helps you by adding two more players.
Right, and outcome may be better also, keeping fingers crossed. So, Ronnie, we could understand Kalpen at this level you are representing, a multi-asset approach as the right way. But since you have the entire research team with you, and our investors definitely want to know what's your current outlook on the equity markets and looking at the current environment.
Sure.
In fact, last 2 days we have been seeing a decent rally. So.
Okay, so typically at DSP generally we get very conservative when markets look very good and actually prices run up sharply. So before prices run up, when the current environment does not look rosy or the past returns don't look rosy, we are more confident about future returns. And on the other hand, when past returns have looked very good, like last year returns are 30 to 40% in most of our funds or in many of our funds, so they look very rosy. The current headlines also look very rosy, right? We are seeing India becoming more dominant in terms of the size of its capex, in terms of a lot of global money coming in terms of local savings coming in, buying equity funds and stocks. We are seeing a lot of focus happening on manufacturing in India, on engineering in India, on our companies becoming more versatile and competing in the global market space. And over time, this could be, it is all claimed that this is the century of India or decade of India, though I personally don't come in that camp of forecasting things. मुझे नहीं पता है, because मैं जब बोरीवली से बेलाट पियर 20 साल पहले घर से ऑफिस जाता था, तो मेरे जो रास्ते थे वो इतने ही खराब थे जितने आज भी खराब है. So headlines is one part, but so India is all progressing 2 steps forward, 1 step behind, 2 steps forward, 1 step behind. So we feel we are at a point in time where the economic landscape has only got better for India. The prospects have got better. India just has to ensure it doesn't do any self-goal or any wrong policy errors. And companies have to continue to execute with very sharp focus and not make big mistakes. In the last bull market of 2003 to 8, great Indian companies made great mistakes of going and acquiring very large companies in different parts of the world by taking a lot of leverage on their balance sheets, and they deteriorated their existing great businesses by buying another business at the peak of the cycle. And for the next 10 years, they paid a price. Indian banks misbehaved by lending money recklessly for these type of acquisitions, or there was a lot of corruption and all the NPAs got built up. Thankfully, we have cleaned up a lot of this mess. Regulations have become tighter and cleaner. Focus of governments is towards quality of growth, not just speed of growth, and that is more important. It's okay to grow at 6% for long periods of time rather than grow at 9% and then come down to 4%. So I think the landscape for India is only more and more optimistic. Now this optimism is leading to large inflows into very few number of stocks. घुमा फिरा के इंडिया में 200 ही स्टॉक है जो इन्वेस्टमेंट वर्दी है, जिनका रिटर्न ऑन इक्विटी 15% के ऊपर होगा या जिनका प्रॉफिट ग्रोथ रेट 10% से ज्यादा है, एंड वेयर the promoters are clean or competent and they respect shareholders. So there are not more than 200 250 companies. Now there are 1500 mutual fund schemes which are trying to put money in these companies because we are receiving lots of inflow through SIPs and lump sum and NFOs and so on and so forth. Lot of investors post COVID have started realizing that खुद की नौकरी में जितना पैसा बनता है उससे अच्छा स्टॉक मार्केट में 6 महीने में पैसा बन रहा है. So a lot of interest has come in terms of buying stocks and becoming an equity investor. Demat accounts have reached a threshold of 12 crores. I don't think there are more than 15 or 20 crore people in India who have net surplus savings, because uske baad there is a huge cliff where people don't have enough money for sustenance. So large part of India is investing, and on top of it global money is flowing in because China का option काफी relatively weak हो गया पिछले 1.5 साल में. So lot of money chasing in a short period of time, less number of stocks. So great companies in a great country have become very expensive, which is not great for future returns. So we are very optimistic about the future, but in the near to medium term, we think prices have run up far higher than what they deserve to be. We do feel markets are expensive. So just to give you a quantitative reference point, the long-term average multiple for a country like India, which has 13 to 14% return on equity and 10 to 12% profit growth rate. Let's say our long-term price to earning multiple should be 15, 16 times. Today it is at 20, 22 times. So we are 1.5, 2 years ahead in terms of returns or in terms of valuations. Now we are expensive does not mean return नहीं बनेगा, or it could mean पहले 15-20 का correction होगा या 2-3 साल का return poor होगा, and then the return cycle will start, or we can become a bigger bubble. What will the future story be? I don't know, but I'm only flagging off that we would be more comfortable investing in equities at slightly cheaper prices than what they are at this point in time.
Fantastic. So I think we are falling short of time. Just last one question. Our investors will want to understand how we will be allocating the international investment. Will it be direct stocks or ETFs or?
See, we try to always optimize from a wide array of choices we have. So from an international stock portfolio, I'll tell you our philosophy will be to buy good companies and at right valuations. We don't want to overpay. We don't want to buy the best of companies which have got priced up so expensive that their future returns could be poor. At the same time, we don't want to buy mediocre companies. Today, when I have a choice of investing globally, I rather choose the winners in every sector or market. So one of our largest holding could be a stock like Berkshire, for example. Berkshire is run by Warren Buffett and Charlie Munger. These are the two longest serving, wisest investors of the world, and they've made billions of dollars, and we all learn from them. So Berkshire would be a very dominant part of our portfolio. Then we will have a combination of some global funds or global ETFs, where those ETFs are narrowing down into companies that fulfill our criteria of high ROEs, high quality, and reasonable growth rate and reasonable valuation. The portfolio could have companies which are in the global automation, global industrials, global defense companies, global healthcare companies, companies which are doing a lot of innovative and disruptive work in the healthcare space. There will be companies which are luxury brands like Hermes or LVMH, or again consumer brands like Diageo, Heineken, London Stock Exchange. These are all 100, 200, 300-year-old brands which have survived and which have 20-25% return on equity. So it will be a portfolio. You will feel nice. Some of these brands you may be carrying in your wallet, in your bag, in your hands. Your mobile would be using a lot of these brands on a day-to-day basis. You would be spending a lot of time on Microsoft or Alphabet. So these are all companies which are powering the world today and have become a very integral part of our life. And likewise, the Indian component also will have a similar dominant companies which are respected, profitable, but not very expensive.
Right, Kalpen. I think we are nearing to the time limit we have for this interaction. So just to summarize to all our investors, the multi-asset approach which Mr. Kalpen has briefly touched upon, and there's a detailed note about it. If you want to get to know more about it, please get in touch with your relationship manager or a customer service desk with us. So broadly, we are talking about investing across multiple assets, which is Indian equities, global equities, debt, and gold, and balancing each out so that to maximize the overall portfolio performance and ensuring that the volatility remains within a known range, so that the investor doesn't get a sleepless nights when there is a jerks in the market. More importantly, in fact, there's a question also on correlation. Yes,
Yeah.
obviously correlation is tested for each the cross assets, so that a question can be provided using the best combination. And there's one question on how so the NFO is on, and all those clients who want to invest, they can log on to HDFC Securities website or Invest Right app, or they can call up your relationship manager or our customer service, and you can transact. The NFO will be open till 21st till 2 p.m. But the sooner you want to participate, you can participate. There's no time limit on that. And thanks a lot, Kalpen. Thanks to all the investors for joining. It's a pleasure interacting with everybody.
Thank you. Thanks, Abhishek, and thanks everyone for joining.
Thank you.
See you.
Thank you.
Good day.
Yeah.
Sorry, Abhishek, we got a bit delayed because of some, this system did not work on our internal system.
No worries. Yeah.
I couldn't catch up. I was there in your office very briefly last week. I come to meet Dheeraj, and I just met some of your equity guys. But I got delayed.
The call, Kalpen, the call is not yet called off. I don't know. I could see some.
Okay.
So yeah, we will discuss that. Yeah. Thank you.
Yeah. Take care. See you. Bye.